It's an act of war. Those are words I never thought I'd hear Warren Buffett say, but he recently said just that in an interview with CBS. And after he paused, he then said somewhat. He kind of took the edge off of that, but he was talking about tariffs. And I think what was really interesting is what he said next, which is you always have to say what's going to happen next. So we put tariffs on a country. What's going to happen next? Obviously, this is playing out. We've all seen it. The other country puts tariffs on us. And in this case, he was talking about China. And what does it mean to us? Well, first, what's Warren's view on tariffs in themselves? He essentially says that it's a tax on you and I. It's a tax on the consumer. And Warren Buffett has all these great little sayings. He says, the tooth fairy doesn't pay these tariffs, which is absolutely true, obviously. And then towards the end of the interview, he says the irony is that protectionism often harms precisely what it claims to protect. American consumers pay higher prices. American manufacturers face higher input costs. American farmers lose export markets. And then he quotes Will Rogers. He says, Will Rogers would say, we're the first nation in the world to go to the poorhouse in a nice automobile. Okay, so what does all this mean to us? First, I'm a big fan of Warren Buffett, and I'm glad CBS News did that interview with him. But as we're seeing it play out, as I record this, the market has made up most of, if not all of the losses from the April 2nd initial announcement of the tariff. So year to date, as I record this, the S&P 500 is actually up for 2025. So it just shows how complex things like this can be. We can get the event right? Tariffs are going to come in place. Maybe you thought tariffs were going to be higher than most people thought, which is what kind of shocked the system and brought the market down. But then you have to ask yourself, what's the market going to do? And the market did exactly what we thought it would do. It went down. But now it's coming back up, even though there really hasn't been a lot of resolution to this. So this tariff situation really highlights for us as investors, for us as people hoping to retire and be financially secure, how do we navigate things like this, situations like this? Well, the first thing is to have a long-term asset allocation. What percent of your portfolio is in stocks? What percent of your portfolio is in bonds? And have that allocation that you can stick with in good times and bad. In that interview, the reporter asked, where do you think the stock market's going to be in 10 or 20 years? And Warren Buffett said, I think it's going to be higher. I think it's going to be higher in 10 years. I think it's going to be higher in 20 years. I think it's going to be higher in 30 years. And I'm sure one of the things Warren also thinks is it's going to be a bumpy ride. But for those of us that can protect ourselves from being forced sellers in a down market, that volatility in the market is really noise. It's really pain. It's unnecessary pain, but it's a feature of the stock market, right? People are trying to predict what's the stock market going to do in 3 months, 6 months, or a year. So a little bit of information today, they're trying to extrapolate that out. And that's why we see big movements in the short term. I mean, how can the market be down 20% in 2 months, right? How does that happen? Well, the way it happens is investors are forecasting and looking forward and saying, boy, this is bad for companies. Yeah, it's just a small change today. If you look at McDonald's numbers, if you look at Walmart's numbers, if you look at any retailer's numbers, they are showing that the consumer is starting to slow. In fact, McDonald's numbers are really interesting because earlier, like 6 months ago, 12 months ago, we started to see the low-income consumer, people with less disposable income, start to cut back on fast food. Now, fast food is no longer affordable food, and I think we could all say it's never been health food. But we saw that first with low-income consumers. But recently, McDonald's is warning that, we're seeing this in the middle-income consumer now, too. They're starting to cut back. So I personally think we've been in a rolling recession, different sections of our the economy have been in recessions. Different sections have been hit harder than others. For instance, in 2022, it was the tech industry that went through a sharp reduction and started reducing jobs. And I think we've seen that rolling through different parts of our economy. At the same time, we've seen inflation drop from almost 10% down to what the Federal Open Market Committee's goal is, which is, about 2%. I think right now we're at about 2.3%. And it's very, very difficult to do that. It's difficult to bring that plane in for a landing on a glide path by having higher interest rates. We've all seen this play out over the last several years. Higher interest rates try to slow the economy, but bring the plane in for a nice, gentle landing as opposed to boom, bringing it down and causing a recession. The vast majority of the time, when the Federal Reserve needs to do this, it does trigger a recession. So, I know Jerome Powell is now a politically charged figure. There's people that love him, there's people that hate him. But overall, if he can pull this off, if he can get us uh, if back to the inflation numbers that we need without triggering an inflation, now it's more complicated now because of the tariffs. So getting back to what we do, I said first, it's having a long-term asset allocation. I'm personally a fan of working with a financial advisor to help you come up with that. You don't necessarily have to work with somebody for 10 years in order to do that. There are fiduciary financial advisors that'll work on an hourly or retainer basis that will help you get that number right for you. And part of this is an academic discussion, but the other part is, who are you as a human being? I could have two clients in a very similar situation, but depending on how risk impacted them, they could have different asset allocations. So you're looking for somebody that understands the academic background to deciding these things, but also looks at the human factors and takes into effect what they've seen over working with clients for a decade or 20 years. So that's the first thing, the asset allocation. The second thing is to have a plan. And to have a plan where you know how much you're saving, you know when you can retire, you know what retirement looks like if you retire in 5 years versus 10 years, and you understand what those trade-offs are, and you're making those trade-offs consciously and deliberately. For some people, working a few more years makes a lot of sense because it's going to give them a higher standard of living in retirement. For other folks, they already have a big enough of a retirement nest egg that working a couple more years, yes, might give them more money to spend, but it's not going to give them more utility, more happiness, more adventures to their life. And for those folks thinking about, the reality is none of us are going to live forever. And so thinking through that trade-off of our health isn't going to last forever, we're not going to live forever. How do we squeeze as much of the juice out of the youth of our senior years as possible? And speaking of a plan, I talked about a financial advisor. I know a lot of folks aren't going to use a financial advisor. If that's you, I urge you to use software that's designed for you to help you make good decisions. It's just too easy to make mistakes with an Excel spreadsheet, with a Google sheet. The software I like is called Bolden. It used to be called New Retirement. And if you use the link in the description below, you'll be supporting the station. This video is not sponsored by Bolden, but I am an affiliate. If you like this video, the YouTube algorithm says this is the next video of mine, specifically for you, that you should watch next. Thanks for watching this one. Bye-bye.